So the big question is this: how are real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we grow a real estate business conservatively to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Mathews, and this is Real Estate Underground. This is the Real Estate Underground podcast show number 55. Hey everybody, Ed Mathews here with the Real Estate Underground podcast. I am really excited today. Today we're meeting with Marco Santarelli of Norada Real Estate Investments and Norada Capital. Marco, welcome to the show and thank you for your time today, sir.
Ed, it's an honor to be on your show. Thanks for the invite, and I'm looking forward to this interview.
The honor is mine. I appreciate it. So for those of us out there who haven't met you or haven't seen you on Facebook or stalked you like I did, can you tell us a little bit about your company and what you do for a living?
That's always a hard question to answer as far as what I do for a living. I used to say, I'm a real estate investor, and then sometimes I'd say I run a small business. But the reality is I'm a serial entrepreneur and investor, and something I aspired to do when I was a young age. So what do I do? The short answer, the one sentence answer is I help people create wealth and passive income. That's really the short answer.
An outstanding answer.
Yeah. Yeah. And to expand on that just for 5 seconds, for 19 years, it's been through investment real estate. You and I both loved real estate. It's truly a great wealth creator. But as the years evolved, and as the years went by, I started, venturing into other business ventures and expanding, our offering. So it's still real estate, but it's also promissory notes and whatnot. I try and keep it very tight. But at the end of the day, what I like to do is educate people on how to create wealth, how to preserve it, how to create passive income, financial freedom. It's something I've always been passionate about since I was a teenager. And so now, I've reached a certain level of success, and now I just want to pass that on. Right
on. And, it's interesting because, you and I come at, I think we're kind of reading the same book, but we're on different chapters, right? Where we invest primarily in multifamily, 6 units and above, your focus has been, and correct me if I'm wrong, 1 to 4 unit residential. And obviously you mentioned promissory notes as well.
Yeah, exactly. So I never really wanted to venture out beyond 4 units for several different reasons. Not that I don't like multi-units. I think they're fantastic. And for your audience listening to this, if they want a really passive real estate investment, syndications are a great way to get involved in that. But I just really enjoy the residential space because that's where I cut my teeth at an early age. I understand it. It's easy to understand. It's easy to swallow. It's easy to deal with.
Right.
I can make an argument that you get a slightly better tenant. That's an anecdotal, opinion, just because you have that personal space, especially when you're dealing with single families and to some degree duplexes.
Sure.
But also 1 to 4 units for me is attractive because I have that 30-year fixed rate conventional financing that I can get for it that you really can't do with commercial property. You've got a 25-year amortization. You might have a 3 to 5 year term that you have to, refinance or recast every so often. So I just like that predictability of locking into really what is the most aggressive and cheapest form of financing. Anyway, each to their own. I mean, it's not that one is better than the other. It's what resonates with you. Where do you want to be?
Yeah, but when it comes to the debt, I'm the first one to admit that you probably have a little less stress than I do on a 3 to 5 year basis.
Probably, yeah.
Yeah. And, I've heard from multiple people, and I'm one of them, right? I mean, the first building I ever bought was a 4 unit. And the fact is that actually may be as close to a perfect investment as possible, right? You can lose 1 or 2 tenants in a 4-family and still cash flow, which is a beautiful thing. And it's what got me hooked on real estate, in that, wow, actually I can get, even if I had to live in one of the units, it would still, cash flow and actually then pay my mortgage down over time. So it's it's probably about as close to a perfect investment as you possibly can get, right?
Yeah, and for a lot of investors, actually, that's a great way to get started because they can, what is referred to as house hack. You know, you could buy a duplex or a fourplex, live in one unit, rent the others out, and it basically covers, or at least full, supplements to a large degree your PITI, your carry costs, and that's a great way to get started. And then after 2 years, you've got the benefit of being able to move up and take those capital gains tax free and leverage that into more property.
Absolutely.
So yeah, so it's a good way to get started.
Indeed, it is. And the good news is that the market's starting to correct. And actually, one of the things I want to talk about is what you see coming. You're on the West Coast in it's
California.
California, thank you. I was searching for the city and I blanked on it. But
Yeah.
But the fact is that here on the East Coast, we're seeing a fairly healthy correction right now, and it may get past healthy and into a little scary over the next 6 to 18 months.
Yeah, I mean, you have to look at the country as
a lot of local markets.
Yeah, you have to look at the country as basically a massive blob of local markets, and even to a large degree submarkets. Right. So I'm always cautious when I talk about averages, because even with the Case-Shiller index, which is the top 10 and top 20 markets. Yep. It's just a barometer, but it doesn't necessarily represent exactly what's going on in every single local market and submarket, because you could literally have a market that's doing well relative to the other markets, and then you can break that down into submarkets and see some markets actually appreciating while others are depreciating. But overall, the trend has been across the country that most metropolitan areas have been correcting. The expectation is that markets are going to correct about 20% on average. Again, I say that loosely in air quotes, because some markets are going to have very mild adjustments over the next 12 to 24 months, whereas other markets are going to correct pretty heavily, especially those that had appreciated very, very quickly in a relatively short period of time. In 2020 and 2021, we saw on average about 20% appreciation rates in a lot of the primary and secondary markets, especially in the South and Southeast. Now, these markets are slowly correcting. We've seen many markets already correct about 20%.
Yep.
But whether that's a 10% or 20% correction, it does help towards affordability, especially with mortgage rates having been going up. Provides opportunities for investors that are looking to come in. But my expectation for 2023, and I don't have a magical crystal ball, but I expect most markets to continue to have corrections, subtle but corrections nonetheless. Yeah. And that will taper out for a period of time as markets start to normalize and we see where interest rates are going, because a lot of people have actually gone to the sidelines to see what happens before jumping into buying or moving up or investing in property. I mean, we're seeing it with the Norada real estate side. We're still getting a lot of investors coming forward wanting to invest in 1 to 4 unit properties in different markets. But compared to the previous 2 years, it's measurably less.
Yeah.
But the correction will continue, although I expect it over the next 6 to 12 months to subside. And I've got some internal tools which are very interesting that actually show me what markets are doing on an appreciation perspective, inflation adjusted appreciation perspective, and whether they're in a wealth phase or not, and whether they're appreciating or depreciating, and where the momentum is. So I can actually make predictions for 6 to 12 months into the future as what that market might do. Now, just as kind of a side note, and maybe just kind of a very loose plug, I am working with a development team to turn this into a public tool where people can go and use it to see any market, literally down to the zip code, and see what's happening in every single micro block around the country in terms of price appreciation and momentum. But that's a long answer to your question.
Yeah.
Yeah, we're seeing some corrections going on. The thing is, you can't have 20% price appreciation, across the country on average, for 2 years. Number one, that's well above the long-term historic average. Right. And number two, it's highly unsustainable. I mean, incomes don't go up 20% per year. I mean, you're lucky if incomes go up 4 to 6% per year. And even if they did, you're going to lose that affordability pretty quick.
Absolutely. And, I keep seeing all these articles and talking anecdotally to investors and, families that have bought in this run up, the mid COVID to post COVID run up of real estate. A lot of people out there who regret buying what they bought. Right. And, but the thing is that, there's kind of two levers there. There is the purchase price, and then there are the terms you got. Right. And so, if I overpaid by 20%, but I have a 2.5% mortgage rate, it's probably a little bit easier to swallow than, having a overpaid and caught that run up on the mortgage side, and I'm paying in the fives or worse still in the sixes plus, right?
Yeah. And even if you think that's a mistake, real estate, fortunately, historically has proven to be a very forgiving asset class. It moves and changes very slowly.
Indeed.
But even if you overpay, time will catch up to that premium that you pay.
Time is definitely our friend, especially for cash flow investors, right? So,
Correct.
So let's talk about your business. So when you're very active in Alabama and Maryland, Baltimore, if I'm not mistaken, and other markets. I'm curious about what you look at. Your website is a wealth of information in terms of what you see in the market, and and it's pretty clear kind of the levers that you look at to decide if it's a market that you want to get involved with. But for the benefit of our listeners, what are some of the attributes of a market that you look at to help decide, yes, this is a good place to invest money?
Stay with us. We'll be right back.
A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
So Norada Real Estate Investments is focused on about 25 markets, and they're predominantly on the eastern half of the U.S. And there's reasons for that. It's because just the numbers make sense there. Most of the markets on the western half of the U.S. just don't make sense. Prices are so high. Rents are not high enough to give you a high enough rent to price ratio. And so they just don't cash flow. A lot of times at best they just break even. So we focus on the eastern half. It's basically the flyover country, Midwest, parts of the Northeast, a lot of places in the Southeast, and to some degree the South, which would be the Texas markets and whatnot, Alabama, Mississippi.
Yep.
There's two things that I look at when I look at markets. There's the fundamentals, and then there's the technicals. The fundamentals are two very, very important things, but they're not necessarily the be all end all. And one is jobs and job growth. If you're looking at a market that has a strong job base, diversified job base, meaning that there are a lot of sectors or industries within that economy, it provides stability, and mostly stability, but potential long-term growth. So you want to see jobs and job growth. If you see job growth, that means that people are going to be moving in, which is increasing demand, and that demand for real estate, keeps prices sustained, or in many cases causes price appreciation. So you want to see jobs and job growth. That to me is kind of like the most fundamental piece of what you need. Tied to that, they go hand in hand, is population growth. Often, but not always, job growth in a particular market leads to population growth because people are moving in from other areas. And so those two things going hand in hand provide, it's economics 101, supply and demand, provide, that stability or growth on the price side of things. If there is a lack of supply and you have strong demand, now you've got a hyper growth market. And that's what we've been seeing in many of the Florida markets. There's not enough housing, but a lot of people are moving, 100,000 people, per year moving to Florida. Now that's creating a bit of a problem because now you don't have the housing to provide these people. So those are the fundamental things: is our jobs and job growth and population growth. Those are the fundamental pieces of it. But there are times when you have both of those factors going on in a market, but you're not seeing price appreciation for various reasons. One is, obviously what I just mentioned, an oversupply of housing. So that hasn't been absorbed yet in order to affect, prices, price increases or rent increases.
Right.
So the next thing you need to look at, which actually segues back into the tool I was telling you about that we use internally, that I'm looking to turn into a SaaS product of some kind in the next couple of months. And that is, the technical aspect of it. Now, so if you think of the stock market and stocks, and you look at a stock chart, and you can see whether prices are going up or going down, and you can, follow the trend, and you could put some tools on it like moving averages and whatnot. Those are technicals. So when you apply technical analysis to a particular market, you can see if there's momentum and where prices are trending. It gives you a pretty reliable short-term prediction. As you go further and further out, it becomes harder and harder to predict because you just can't see that far into the future.
Right.
But there's a fair amount of reliability, when you're measuring in terms of 6 months, 12 months, and sometimes 24 months down the road. And so those are the two things I like to look at.
Okay.
Yeah, it sounds complicated. It's not all that complicated.
No, I mean, if you break it down, I mean, let's unpack it a little bit, right? It's do people have work? And are those opportunities growing, stable, or shrinking, right?
Mm-hmm.
And, what does the supply of homes? So, I mean, 2008 was absolutely devastating to the construction industry. And a lot of those general contractors who would have built single family homes all the way up to 4 families, and frankly, even apartment buildings, a lot of them went away. And so there is, I see different numbers, but the macro number in the US is, last I checked was like 3.8 million housing units behind where we need to be. And it's directly tied to, the 08-09 crisis, right?
Yeah.
So, where you look at markets and say, and we look at similar things, right? I mean, obviously we want to know that there are jobs. We want to know there's job growth. We want to know that there's diversity. In our world, we focus on employment. No one sector owns more than 20% of the employment base. So we know there's good diversification. And, then it comes down to, market factors like rent or, income, monthly income. And, it starts to help us zero in on where there are healthy, stable, or growing economies, right? And that's where you put your money.
Yeah, and you're right in everything you said. I would probably even venture to guess. I mean, based on data that I've looked at and information from multiple sources, that the housing deficit is probably closer to 5 million, 5 to 5.5 million.
Wow.
We need a lot of housing, to keep up with both, the organic population growth and the immigration growth. So right now we're on a pretty good trend to meet the requirements by 2030. But we're still running about a 5.5 million housing unit deficit in the country. Now we'll catch up. I mean, builders have been acquiring massive amounts of land, buildable land, and they've been building like crazy up until, the mortgage rates going up this year. They were just building as much as they possibly could, as fast as they possibly could. They've been pumping the brakes this year only because mortgage rates have gone up and they've seen sales slow down. So they're trying to keep cash flow moving, in the sense that they're providing some forms of incentives to keep buyers interested in coming in and buying their inventory, so that they don't have standing inventory.
Right.
But that'll clear up. Next year, like, things will start to pick up again. At some point, the Fed has to take their foot off the brake. They're going to stop pumping the brakes, because they're going to crush the U.S. economy if they continue their quantitative tightening.
Right.
So we'll see it pick up again.
Yeah, I think from what I'm reading, that we're right on the edge of a soft landing, right? And so, and it's some art and some science in terms of how to, which pedal to hit and how hard to hit it, over the next 6 to 18 months. Powell has a very difficult job ahead of him.
Yeah, it's a tightrope for sure. I mean, he's definitely walking a tightrope. He only has so many levers to play with.
Right.
It's probably one. So
Right. Right. It's interesting. You'd mentioned that developers have kind of dialed it back in terms of build for sale, but build for rent here in the Northeast, for instance, is exploding. Right. I mean,
yeah.
there are apartment buildings and and just single family single family neighborhoods built to rent. Which I interviewed a gentleman down in Tennessee. That's all he does, right? He's buying farmland as fast as he can get it in house, and turning around and building single family homes in the Nashville, Tennessee area, and is absolutely thriving, and can't keep up with demand. And around here in the Northeast, a lot of multifamily development. So it's interesting. You see the ebbs and flows of build to sell versus build to rent.
Mm-hmm.
I see that that's changing. The other thing that's interesting is you were mentioning about interest rates and price pressure and all that. About 3 months ago, I finally started to see a little bit of capitulation on the seller side. Where things were being repriced, things were being taken off the market for a period of time and brought back on, and offering price relative to sale price. There's finally a difference in the number, and it's a negative drop as opposed to a positive increase, right? So the market is definitely, the dynamics of the market are absolutely changing. You're 100% right.
Yeah, and inventory is starting to increase. I mean, we're starting to see it actually changed very quickly this year. We saw a struggle to get inventory. That pendulum shifted, and now we're seeing a lot of inventory. In fact, we even have builders coming to us right now saying, "Hey, we've got inventory to unload or move. Can you help us?" Yeah, wow. It was a very, very quick change.
Yeah, and is that inventory land to build, or is it actual housing units that are already built?
It's residential. It's residential property, wow. Mostly single family homes, predominantly single family homes, but it's like available inventory. Right. It's like, hey, we've got this inventory. It's slow going. We need to move it. Can you help us?
Yeah. Can you take this off our balance sheet for us?
Yeah. Before, like, 12 months ago, we were begging to get inventory.
Right.
So. Yeah.
End of summer, early fall is where we saw a change here in the East.
Yeah.
In the Northeast. Yeah.
Yeah, that's the interesting thing of for your audience to know is it's very, very rare, if not quite impossible. I don't want to say that. It's very rare to find a state of equilibrium in real estate. To me, I call it a pendulum. It's swinging one way or another.
Right.
It goes from a seller's market to a buyer's market and back the other way, and the pace changes, but it's never stagnant, and that's what keeps real estate very interesting. There's always opportunity out there. It's just going to be market specific, and you have to just look at where to invest. And I always say, look, it's never ask me the question, is it a good time to invest? Because my answer will be, it's always a good time to invest in real estate. It's not a question of when, it's a question of where. And this is why I always teach people to be market agnostic. Never be married to a particular market. Don't feel that you have to invest in your backyard or within a 1 hour or 2 hour radius of where you live. Sure. That's just silly. The gurus talk about that because they feel that you should be hands-on and involved in your local market. Well, the thing is odds are you're probably not managing your own property, and you're not going to be swinging a hammer. So if you're a passive real estate investor, look at the country made as being 500 plus markets. Don't look at the market or your opportunity being just your local market where you live, because you're going to be missing out on lots of potential opportunities that exist around the US. So be market agnostic. Just understand that all real estate is local. You should focus on the markets that are going to put your money to work in the best way possible, the hardest way possible to generate the greatest gains in terms of cash flows and gains in terms of appreciation potential. And if you have that mindset, then you'll realize that you're playing in a very, very large pond.
Yeah, absolutely. And the fact is, you should be putting your money where you're going to get the best return, right?
Always.
And, that is almost always not your backyard, right?
Correct. Correct.
It's cyclical. It'll eventually be your backyard, but not always, right? In fact, most of the time it won't be. So, right. That's where guys like you and me help investors figure that out and deploy their capital with a little bit of science, right?
Right. Yeah. True.
Right. So how did you get into real estate? I mean, obviously, did you have a finance background, or what drew you to real estate as opposed to, I mean, obviously, somebody with your intellect and capabilities, you could have been in the stock market, you could have been in oil and gas, you could have done a lot of different things, right? But why real estate?
It's funny because the city I grew up in was heavily, and still is heavily, based on oil and gas. I mean, that is the main driving part of the economy. I hated that. It's just, it had no interest. I just knew it, when I was a teenager, I just knew that I wanted to be financially independent. I didn't know what to call it at the time, but I basically took it upon myself to study business, entrepreneurship, and real estate, like investing, but mostly real estate. And I was doing that at about the age of 15, 16. And nobody pushed me in that direction. It's just, I looked around and observed, and I realized, okay, I want money. I want lots of it. I want to be financially free. Yep. What are other people doing? And I realized that they were either entrepreneurs, like business owners, or they owned real estate. And so I educated myself. And then when I turned 18, I went out and bought my first rental property. And it was just an end unit townhome. I think it was a 3-bedroom, needed some work. So I fixed it up. There was no internet back then. So it was like newspaper and signage in the front lawn to, say for lease. I interviewed, in air quotes, people, not knowing what I should be asking them, but I just picked the person that I felt comfortable with. And that was my first tenant.
Right.
And that's how I got into real estate. I mean, the writing was on the wall at that point. But I just knew that business and real estate were the ways to create and preserve wealth.
Indeed. Yeah, it's funny. You just mentioned something. I remember a story. So my niece years ago, so I was in technology for a while, and my niece asked me, Uncle Ed, what was the internet like when you were my age? She was probably 12 or 15 at that point. And I said, well, kiddo, it was a secret military project when I was your age. Nobody knew about it. Something called ENIAC or something like that. But so there was a time where we actually had printed maps and printed newspapers, and we actually shook people's hands and met them and introduced them to our properties. And that actually was a real thing. That's not legend. That actually happened.
Yeah, it's hysterical to think that you had a 1.5-inch Thomas guide in your car all the time, you're flipping pages to find out where you're going.
If I looked hard enough, I probably still have one in my basement somewhere.
That's hilarious.
Yeah. So when you look at markets, and you're looking at it from a single family to 4-unit versus promissory notes, how does your calculus change in terms of what you're looking for in that kind of market, and what are you looking for when you're looking to do note investing? Well,
I'm not sure if I'm going to be answering your question, because I'm not sure what you're asking, and let me explain why I see that. When you invest in promissory notes, it's an investment. When you invest in real estate, it's an investment. I call them fruit. They're both fruits, but they're two different kinds of fruit. A promissory note of any kind, I've done webinars on this. It's a one-dimensional investment. It's a paper asset. Okay, it's not a hard asset. It's a paper asset. It provides a rate of return based on the terms of that note. It could be just interest only. It could be paid monthly, quarterly, annually. It could be a balloon payment. I mean, there's so many variations of it.
Sure.
And promissory notes could be anything from a car loan, a bike loan, a mortgage loan, a personal loan. Those are all various forms of promissory notes. There could be performing, non-performing, secured, unsecured. I mean, there's all kinds of flavors of promissory notes. But what they do is they provide a regular rate of return. Again, it could be one-time balloon, it could be monthly, whatever. That's great for a lot of investors, especially if you're investing in a self-directed retirement account. It's beautiful for that.
It's fantastic.
Yeah. But when you it's kind of a little bit difficult to compare that to real estate, because when you look at real estate, yes, you have cash flow. It could be monthly or quarterly, depending on what the deal is, a syndicated deal or a rental property.
Sure.
But you also have other dimensions to investment real estate. You've got the tax benefits through the depreciation. You have the amortization of the loan, which slowly then fast builds equity. You have the appreciation that comes over time which also builds your, your wealth, your net worth. And then you've got the leverageability of it, because you can essentially leverage your investment capital 5 to 1 on the real estate side. So you've got all these things involved with investment real estate, which is what makes it incredible and beautiful. So, you compare that to something else like promissory notes. Yeah, they're both investments. The one thing they do have in common, yeah,
or
one thing they have in common is they got cash flow.
Potatoes, still fruits, but right. Yeah. Okay. So, as far as the underlying asset, how big a role does that play? And you mentioned cars and, real estate and other types of loans, personal loans, the promissory notes. I'm just curious about this. And then we're going to head back to the real estate stuff, but how much do you actually care about the underlying asset?
Are you asking as if I was investing in a promissory note?
Yes, I am.
It really, well, it's a good question, because there's really two ways to look at it. If the note is a real estate based note, meaning it's like a hard money loan, a short-term loan, or a long-term mortgage loan, then yeah, the assets plays heavily into it, because that's how you underwrite a real estate based loan or a promissory note. It's all about the asset. However, if the promissory note is a business loan, it's going to a business venture or performing business that's got assets or other business ventures going on, and it's a viable business, there's revenue and cash flow, well, then it's different. It does, in that situation, it probably won't be secured, it'll be unsecured, and that's fine, because that is the expectation. Secondly, now you're underwriting the business itself or the fund, and so you're looking at the stability and maybe the diversification of the assets or businesses, within that entity or that venture.
Gotcha.
So at that point, you're underwriting it a little differently. It's not a secure loan. It's based on the performance and history of that business venture, or the future potential of it. I mean, if it's got strong alpha, like very high upside potential, even though there's risk, the upside, 5 to 1, 10 to 1 or more could far outweigh, the potential downside of it. And so you're looking at it a little bit differently there. Yep. Someone who's investing in a real estate note is going to be thinking differently than someone who's investing in a business or business venture through a promissory note. They're slightly different animals. Sure. So the short answer is it depends. The long answer is, you dig into the weeds of it.
Right. So in terms of, we're going to switch back to real estate now. So in terms of the markets that you're currently looking at and how you think things are going to play out, it sounds like we're in for a bumpy road, but I'm curious, one of the things you said earlier on was that it's always a good time to invest in real estate, right? It just comes down to, the terms and the price point and other factors. So I'm curious, going into 2023, how is the fact that the Fed is doing what is taking its actions, pricing is obviously changing, flexibility is changing, inventory is obviously going up. How is that affecting your strategy going into next year?
It doesn't change my strategy, because my strategy is always to buy and hold income producing rental property that are in good markets. We talked about the fundamentals,
right.
And in good neighborhoods within those markets, which is critically important to me. I put far more weight on the areas and neighborhoods within a market than the market itself.
Right.
I start with the market because I have this, it's one of my 10 rules, it's take a top-down approach. You start with the big picture macro and you work your way down like a funnel till you ultimately get to the property that you're, underwriting. So you don't start with the property and work backwards. You start with the market and work inward, down.
Right.
So for me, I look at the market, and then I consider the areas and the neighborhoods and make sure that I'm in the areas that have the right, demographics and growth potential. They're desirable areas, strong rents relative to price and all that stuff. That's kind of the approach I take. So again, like I said before, it's not when, it's where. And right. So I might have been all in, and a lot of our clients were all in places like Dallas, and San Antonio years ago. but those markets those markets changed. It's hard to get inventory. The numbers don't make as much sense now as they used to.
Sure.
So you change your approach. Now we're looking at, the greater suburbs of Baltimore, places in Pennsylvania. I mean, these are all markets we're in. Some places in markets in Alabama, Mississippi. Still, we're in many markets in Florida. Florida's still, doing very, very well. So, our focus is there. My focus is there. Even Kansas City, Missouri, we're focused there because there's inventory. The numbers make sense. There's still opportunity. And even if the market is correcting a little bit, let's just say, I'm in escrow right now for property in Kansas City, Missouri. I already have a portfolio there, but I'm adding to it because I came across some deals that actually make sense. Everything panned out.
Right.
But I'm focused there because I'm still very bullish about that market.
Sure.
Both short term, but especially long term. I've already gotten familiar with it because I was investing there, but now I'm just adding to my position.
Yeah.
So yeah, I mean, you just take everything into consideration. But again, like I said, it's about where you're investing.
Yeah. So that's an interesting point. It's not that the strategy changes, it's that the location where you're investing changes, right?
Yeah, my strategy is buy and hold. The strategy doesn't change. My criteria is more or less the same. My checklist as far as how I underwrite everything from the market down is pretty much the same. It's the biggest variable is the location. That's what changes.
Right. That makes total sense. So one of the things that I have this theory, and I'm on a mission to prove it correct, which is that
correct or incorrect
for that matter, but I'm hoping I'm right. That leaders are readers, and so I'm curious. Obviously, someone as accomplished as you, you take in information from a whole host of places and sources. So I'm curious, how do you consume information that you use in your life, whether it be books or audible books or recorded books or podcasts or YouTube videos or something else, conferences, whatever. I mean, how do you consume information? How do you sharpen the saw?
The answer is D, all of the above.
Right.
Yeah. So no, it's true. You saying, leaders are readers. That's true. I like to say the more you learn, the more you earn, the more the more the more you grow.
Right.
That is a common denominator across all successful people who are high achievers and are actually, making crap happen.
Yep.
Is they are constantly educating themselves, whether it be daily or weekly or even monthly, but on an ongoing basis. And they have the hunger and the thirst to learn more and acquire more information because they can take it and apply it to their lives.
Right. And that's a key word, right? Apply. Don't just read it and drink through the fire hose and file it away. Actually make something happen with what you learned.
Sure. I mean, you could be one of the most educated people in terms of finance and investing, but if you don't actually do something with it, you're going to be the most educated broke person.
Right. You're going to be the smartest guy at the unemployment line, right?
In the soup, the soup line, right?
Right. Yeah.
But as far as consumption goes, like anything goes, for me, it's anything. I love to read. It's podcasts, it's YouTube videos, it's courses, it's live events, masterminds. I've been in masterminds for many, many years. In fact, we have our own high-end mastermind as well. But I'll learn and consume however I can.
Yeah. So what are you paying attention to these days?
Who or what?
Who or what? Like what's on your nightstand or on your iPhone right now that you're going to listen to on the ride home?
Yeah, well, the new book I just started is it's actually Michael Hyatt, who's got a lot of New York Times bestsellers. He's a lot about leadership, business development, entrepreneurship. He's got a book. It's not that new. It's a few years old, but it's called Time to what's it called? Actually, I think I wrote it down somewhere here. Free to Focus. I was going to say Time to Focus. It's about time management.
Right.
And that's always a big hot button with like high achievers and entrepreneurs and successful people or investors is, how do I increase my productivity? How do I get the most out of my time and not waste time? So for me, for the longest time, as far as I can remember, I've always been fascinated about time and time management, because it's the one thing we all have. It's the one thing we can all spend, but it's also the one thing you can never get back.
Right.
And so time is important. Time is precious. And so I try and read, every once in a while, like, books about time management. But yeah, Michael Hyatt's book, Free to Focus, I just finished like the first chapter or whatever. It's very, very good, by the way.
Yeah.
What's that?
No, I'm going to pick it up. I make a habit out of speaking when I'm speaking with folks like you. If I haven't read the book that you mentioned, it's next on the list, or at least makes the list.
Yeah, it's well worth picking up. I mean, I've already thumbed through it, so I got a pretty good sense. But we had Michael Hyatt as one of our invited speakers at our mastermind at Power Room. Wow. And so I got, before he went on stage, I was with him in what we call the green room for about an hour and a half. So I got to learn a lot about him and get to know him quite well. Yeah. Very interesting guy, very knowledgeable guy. But yeah, it's well worth picking up, a book like that or something similar. But Free to Focus is a good one.
Okay. All right. That's on the list. Thank you.
Yeah.
So when you're not talking about real estate and you're not reading Michael Hyatt books, how do you like to spend your time? What do you do to unwind, and what are your hobbies?
That's a funny question, because sometimes I'm not even sure I have any hobbies, because I actually enjoy work and business and entrepreneurship and investing so much that, to me, it is my hobby.
Yep.
I don't feel work is work ever. I just do the things I do that ultimately help other people, whether it's investing in real estate or investing in promissory notes, because I enjoy it. I mean, it's part of me and I'm involved in it. And so for me, it's always a constant ongoing challenge. But outside of that, I guess the two things I'll throw out at you is one is I enjoy playing poker. I'm a pretty good poker player. I play in a lot of tournaments. Go to the World Series of Poker. For me, it's kind of like three-dimensional chess. It's just further works and exercises my brain. I want to be challenged. I want to solve problems, and so poker for me is just a great way to do that. It's like playing chess, but at another level. Right. That would be my fun time and my hobby time. So, of course, I love spending time with my daughter.
Yeah.
Outside of that, this sounds like the fun thing to do, but it's really a business and an investment. But I'm co-producing multiple Broadway musicals. So,
that's fantastic.
So yes, those are businesses. Yes, those are investments. But they're also so much
labor
fun.
of love, right?
There's a lot of labor of love in there. I've always loved theater and musicals. My daughter's heavily involved in performing arts and whatnot. So, but we just earlier this month, actually, it was December 4th, we had opening night for one of our productions, which is it's called A Beautiful Noise. It's the Neil Diamond musical.
Yes.
Yeah. So So I'm actually the largest single investor in that production.
Wow.
So we had an amazing opening night. Neil Diamond was there. He actually sang after curtain call. We had the cast on stage, and all 1,200 people in the theater were singing along Sweet Caroline along with him. It was just a magical moment.
I can only imagine. Wow, I've got goosebumps just thinking about it.
It's great.
Yeah. Wow.
It's well worth seeing. It's a lot of fun. It's a great. If you like theater in any way, shape, or form, or Neil Diamond, you'll love this, because it's about his life. This is kind of like his official, unofficial autobiography in the form of a musical. Like he's fully endorsed it, because this is how his life and legend will live on.
My I don't know if this is good or bad, but one of my dogs is named Caroline after Sweet Caroline.
Oh, no kidding.
Yeah, for sure. Yeah. And
that's cool.
So that's, we really enjoy the living so close to New York. It's one of the things that we certainly treasure ourselves. I was just there. We weren't on Broadway, but we saw the Rockettes this past weekend. So
cool. Yeah. That's been there a long time.
Yeah.
That's awesome.
Yep. And then we made our annual trek to Ellen's Stardust Diner to watch all the kids who are trying to make it on Broadway sing their way through serving dinner and cooking and all that. So it was a lot of fun.
Nice. Yeah. Very cool. That's very cool.
So, well, Marco, thank you so much for your time today. It's been a pleasure finally meeting you. Like I said, I've been chasing you on Facebook and other places for quite a while now, or social media for quite a while. So thank you very much. I certainly enjoyed this, and I feel like I'm a little bit smarter just having spoken to you. So thank you.
Well, thank you, Ed. I appreciate the invite, and Happy New Year to you and your entire audience.
Thank you. Continued good fortune. Marco Santarelli, thank you so much.
Thank you.
All right. This has been the Real Estate Underground podcast, a Clark Street Capital presentation. Thanks for joining us. If you're enjoying the show, please remember to subscribe and share it with your friends. If you'd like to learn more about Clark Street Capital and our upcoming projects, please join our investor club at clarkst.com/join. Until next time, happy investing.
This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.